Welcome to our Sunday evening live Q&A, and we'll have an hour together. And just a few things I'd like to kind of kick off with. First of all, thank you so much. We had a live stream last time and I asked you to sign up for our podcast, Many Happy Returns, on YouTube, because we just launched the YouTube version of it. And many of you did. Thank you for that. And let me just highlight that again because, I thought it would be interesting to see that. Let me just maximize that. So the latest episode is called Mean Reversion in Markets, What Goes Up Must Come Down. And we currently have 555 subscribers on YouTube. If you could subscribe, it's very easy to find. Let me quickly show you how to find it and share my screen. So simply go to, let's get the URL. The URL is youtube.com/ and then the @ symbol, Many Happy Returns Podcast. So it's youtube.com/ Many Happy Returns Podcast. So you can see it up here if you want to subscribe. So if you could subscribe, it would help us a lot. And listen on YouTube, because I think, it's a pretty good way to listen to podcasts. And obviously it helps us, so we'd appreciate it. Now, it was interesting, that topic, because this was before we got the wobble with things like NVIDIA, which happened this week. So let's have a quick look at NVIDIA. Now, this is obviously in the news. It even was in the BBC News. That's how big the sell-off was. So if you add up the total market cap lost by NVIDIA over the course of this sell-off, it's about 1/10 the size of the UK entire stock market. So 1/10 of the UK entire market cap wiped off in one day, which is astonishing. And this is, remember, a company which essentially doubled its revenue, or more than doubled its revenue, over the course of a year. So just imagine what would happen if it had an earnings miss, or actually an earnings fall. There'd be a huge sell-off. So I think the expectations which are baked into NVIDIA are just so high that there will be a disappointment at some point, and the sell-off could be brutal. And this is always the case when you have a euphoria and it kind of subsides, which is that you get a fairly brutal correction. So this is why, if I was investing a lump sum right now, I'd probably drip feed. And that's been true for some time. The US has been looking expensive. So that's why, I'd be cautious. If I'm just earning and investing, which I am, then I don't hold money back. So, Laura and I recently, we put some more money into our pensions, and it was literally the day of the sell-off, or the day before. So I was joking to Laura that Laura's waters weren't very accurate this time around. So, yeah. But, if you are saving, earning, saving, and then investing, then I wouldn't hold back money from the equity market, because it usually doesn't make sense to do that. Usually you'll underperform if you do that. So, I just carry on because it really won't make a huge difference long term, these kind of setbacks. But remember that the median time that the S&P, for example, spends below its all-time high, if it falls off it, is 60 days. 2 months. That's a typical pullback. So it's very unusual to have very long periods when the equity market falls and doesn't recover. So, it's not usually worth selling at the first sign of trouble. Okay, so let me get back onto your questions. If you super chat, obviously, we'll push you to the front of the queue to answer your question. I can see we've got some already. We have several already. And if you're one of our supporters on YouTube also, we'll push you to the front of the queue. So please do super chat if you want to ask a question. And if you support us on YouTube also, we'd appreciate that. So let me start working through the questions. The first one, I should say like and subscribe. Always have to say that. Please like this video and subscribe to our channel. Great. So first question is from Alberto, who says, during COVID 2020, market sell-off During the COVID 2020 market sell-off, stocks, bonds and gold crashed all together at the same time. Why? What could have protected my portfolio? Cash, for starters, would have been a good place to be. Actually, if you look at, let's have a quick look, because I think that was an interesting sell-off. Let's have a look at a money market fund, because that was very safe. Now there was a glitch, interestingly. So this is CSH2. This is an ETF, which is a money market fund in the UK. There's a Euro version of this. So you can see the return on this is very low volatility. But can you see the kink that occurred during this period of dislocation? Now, presumably that was due to the money markets selling off. Who knows? Because Amundi's not very forthcoming about how this fund is managed. It does rely on a return swap with 3 counterparties, 3 French banks, investment banks, and at that time I think it was just one investment bank, but maybe there was some kind of glitch in the mark-to-market process. Maybe it was a fall in short-term fixed income instruments. But if you look at the size of that dip, it's actually very small. So how big? Yeah, minus 0.4%. But compared to the daily variation that you normally get with this, it looks huge. So that worked very well. And there wasn't a problem longer term. And that dip, you can see, happened over a very brief period of time. And if you zoom in, you can't actually see it in the intraday pricing. So, you know, that money market funds held up perfectly. Cash, of course, you don't lose money with cash. You just lose it slowly with inflation, the buying power. But that worked very well. Let's have a look at some gilts now, because those are kind of interesting too. Let's get some gilts and we'll sort this by maturity date. So we get the kind of short-term stuff first of all, and then we'll go for the crazy 2073 bond, just so you can see what happened, which was interesting. So, you know, this is a low coupon bond. Let's go back, see if it was around in 2020. Yeah, let's go for another bond that's been around for longer. Here we go. So here's a 2028. Oh, this one's index linked. I don't want that. Let's keep it simple. Yeah, this one will do. So this is a bond which matures in 2028. The coupon's 1 5/8%. And let's zoom in on the 2020 sell-off. Now notice what happened is there was a very brief fall and then there was a very rapid rally. So what was the overall effect? Well, let's zoom in. Of course, this was a very scary week because equity markets and it seemed bond markets were in free fall. Notice also how the normal volatility that you see in the price of this bond essentially stops. And that tells you that the liquidity in this bond dried up and it didn't trade much. And you can see in the volume down here, there wasn't a spike in volume. So you can essentially see a market which had frozen up. But after a fairly short period of time, about a week, notice what happened. This is after the Fed stepped in huge size. And if you haven't read $1 Trillion Triage by Nick Timrose of the Wall Street Journal, if you haven't read that, I strongly recommend it, because literally he goes through it almost day by day through the crisis period and talks about exactly what the Fed was doing, the people who were involved. It wasn't just Jerome Powell, it was an incredible team that was around him. Lael Brainard actually comes out of it really well. She's amazing. Maybe she'll be a future Fed chair. I think she'd be brilliant. But, you know, just the cast of characters that were involved that you never normally hear about, but which basically saved the day. You know, they bought all the markets which were frozen up, municipal bonds in America, US Treasuries. And guess which day that happened? Yes, it was just before the UK bond market recovered as well. So what happened overall? Yeah, this equity market, this bond, for example, actually was a pretty good hedge. So let's add, in addition to that, I don't know, the NASDAQ, that would have moved in a crazy way. So here's the NASDAQ, and we'll zoom in 2020, just so you can see the two side by side. So did this treasury bond work as a hedge? Yeah, it did. So, treasuries and gilts worked as well. And let's go for the crazy 2073 bond now. So this one's got an immense duration. So a duration of about 30, 40 years, because it matures in 50 years. So let's see how it doesn't go back to 2020, unfortunately. Oh, this one does. Here we go. So this is the 2071 bond, TG71. And let's zoom in again. So you can see the period of illiquidity here. It kind of plateaus, doesn't move for a long time. People would have been holding their breath at that point. It goes into free fall and then very rapidly recovers when the Fed stepped in. Compare that with what was going on with the NASDAQ, and you can see that yes, this thing actually rallied. Why did it rally? Because people were scared. When people are scared, they buy treasuries and gilts. So I think it's clear that there was a bit of a wobble in the gilt market and in the treasury market, but because the Fed was there as a stopgap, as a kind of fallback measure, which they are the kind of buyer of last resort as well as lender of last resort, it turns out now. They were very effective, they acted in huge size, and they restored confidence to the treasury market, both in the US and elsewhere in the UK, as you can see. So that worked pretty well. Now let's take a look at gold, and like you say, I think gold didn't work very well. So gold 2020. Yeah, so gold is the black line. So it certainly fell, but then it recovered again. So was it as good as treasuries? I don't think so. But it did hold its value. And this is the value of gold, which is when people are really scared, usually it holds up pretty well. Although in this case, it did have a bit of a wobble as well. So you're right, there was a kind of temporary period, about a week, when it just seemed as if everything was selling off between the 13th and the 20th of March 2020. But because the Fed stepped in, I think that restored confidence, even to the things which are supposedly safe havens, like gilts and gold. So yeah, I think there were hedges that worked, and frankly, it was such a short-lived sell-off, even for the NASDAQ, that, I think people who lived through it incorrectly think that you don't get big, long drawdowns. You do, and it's painful. But will the Fed step in? Only if there's a systematic threat, a systemic threat to the financial system. They won't step in just because markets have sold off a bit. That's not their job. So I hope that kind of answers your question about what worked as a hedge. Money market funds, cash, gold, treasuries eventually, after that wobble. So yeah, those things worked. But why? Yeah, I think people were just concerned that everything was going to tank, because think about unprecedented things, right? There was the last time we had a global pandemic of that scale was 2018, so over a century before, and people just didn't remember it. And I think if you don't have a precedent, then you panic. And people just thought, well, if we're shutting down the economy, nothing's going to work as a hedge. If I've got gold, maybe people won't accept that, even in terms of stuff I can barter for potatoes, So that was the worry. And treasuries, people thought that the treasury market was going to freeze up. It did. The liquidity froze up in the treasury market. So all of these systems, all of these kind of trading systems, we rely on the ability to sell things in order to realize value. And if it looks like the exchanges are going to shut down, then you're left with a useless piece of paper or an electronic record, which no one gives a damn about, as the world burns. That's the worry. So you can see that if society did collapse, then a lot of these things would not be useful. Bitcoin, for example, it always makes me laugh that people think that's a hedge in really extreme cases. But if you don't have an electronic network, Bitcoin's not going to be much use. Gold, actually, because it's shiny and durable and doesn't tarnish, would be a pretty good hedge in that kind of societal breakdown scenario. Yeah. So anyway, look, I think all of these extreme sell-offs are very rare. So I don't think people should focus too much on them, but they do. You know, if I make a video on YouTube with the word crash in it, it gets double the number of views than my normal videos would get, because people like to worry about that kind of thing. Doom porn does really well, but I think it's misleading, and that's why I don't put out much doom porn. You know, unless there's been a sell-off, and then you'll see I say, don't sell. You know, don't panic. But look, that's just human nature, I suppose. The next question, do like and subscribe, I should say, is from Sam Baker, who says, a super chat, thank you, Sam. Through my employer, I can buy Tetra Tech at a 15% discount. The price to earnings ratio seems very high. And I know you've mentioned previously the view that you're already long your employer. Yeah, that's right. It was actually someone at the investment bank I was working at, and I was talking about the options that we used to get. And I said, oh, what are you going to do with your options? And he said, I'm going to sell them as quickly as I can because I'm already long the company, which I thought was a good point. Made me laugh at the time, but I think it's actually quite profound. Tetra Tech, let's have a look at Tetra Tech. I mean, if it's a specific question about that company, I mean, it's not one I'm familiar with. So let's have a look then. Maximize that, share my screen. Tetra Tech. Tetra Tech. Is it one word? There we go. So what is it? See if it's got a description of what the company does. What does it provide? Yeah, here we go. So it's a global provider of consulting and engineering services. So I'm thinking cyclical. It's focused on water, environment, sustainable infrastructure, renewable energy, international development. It's leading with science to provide solutions for its public and private clients. And it's based in Foothill Boulevard, Pasadena. I know that boulevard. Okay, so let's have a look at the ranks. So quality, very high, 94. Value, very low, so it's expensive, like you said, I think. And then momentum, 92. So in terms of earnings growth, in terms of price action, it's actually looking pretty good. Let's have a look at the earnings per share. And you can see that those have been steadily increasing since 2018, which is nice to see. The price to earnings multiple has been fairly stable, but quite high, the range. So it's been varying between 25 times and 42 times forward earnings. Dividend yield is low because it's a growth stock, presumably. And what else can we say about it? Yeah, looks a little bit toppy in terms of price. So if we look at the price to earnings ratio, it's 31.9 times. So it's looking expensive. It does have a fairly high stock rank, 80, but not particularly high. But would I stay exposed to it? Probably not, because like you say, you're already long that industry, that sector, that company. And if you can sell it without incurring a huge capital gain or whatever, you know, if it's not going to come at a huge cost to you, then I think it probably would make sense to diversify. But I think having this kind of loyalty to a company is a mistake, because the company will not probably be loyal to you. That's what my father always told me, and I think it's been true. You know, it was borne out by my experience as well. So, you know, don't feel some kind of loyalty to the company which makes you keep its stock. Maybe it's not this stock, maybe not this company that you work for, but yeah, I'd say don't get too much exposure to one stock, whether you work for it or not. Yeah, that's just my tuppence on it. I just hope that's helpful. But But, it looks like a reasonable company, so good choice of company to work for. Interesting business. The next question is from Alberto, also to Super Chat. Thank you, Alberto. And he says, was Warren Buffett extremely lucky or extremely skillful, or both, in beating the market? In which time frames was he most successful and unsuccessful, and why? Great question. And yeah, I used to have quite a few prezos for Warren. So let me see if I can find one, because I used to have this graph I'd trot out at the beginning in the old graphs. Buffett. Here we go. No. Yes. There we go. I think this one was called Warren Buffett's Wisdom. Here we go. This is what I wanted. This is where my slides used to be white on white. So somebody told me that if you watch on TV, it would just be a glare. So you couldn't watch the videos on TV. Let me just move my face over here. So you can see that this thing, what this is a graph of is he writes this letter to shareholders every year, and let me see if I can find the bit where he does. No, I can't find it. But at the beginning of the newsletter every year, he'd give the returns year by year. So all I've done is I just typed them into a spreadsheet and I plotted them. And I've also overlaid this kind of envelope function, which is the red line, which shows the maximum over the last couple of years. So you can see in 1976, there was 106% return, unbelievably big for such a large fund. Of course, it wasn't such a large fund in those days, 84%. And then notice what happens gradually over time is that those really large returns start to diminish. And that's because the fund simply grew so large that you can't have unbelievably high returns for mega caps. It's very unusual. NVIDIA is very unusual in that sense because it behaves like a small cap, but it's a mega cap. That's why it's got a market cap of what it kind of bobbed around at $1 trillion. But it's very unusual. Once the companies that you buy are larger, the growth you get is slower. And even if you're the most amazing stock picker on earth, if you're managing $1 trillion, you can't buy mid caps or small caps because you couldn't buy meaningful size unless you buy the whole company, which he does, but then it's not a listed company. So I think that's the problem. It's the problem of scale. And we started to see it with funds like Fundsmith in the UK when it was popular, before it started underperforming, that there was so much capital going into the fund that I was concerned that it was going to become like Berkshire, which is that it couldn't have access to so many opportunities because of its size. Although poor performance has actually solved that problem for Terry Smith. But overall, you can see that the problem of scale here. Once you get really big, it's difficult to come up with those market-beating returns because effectively you become the market. And in fact, it's now part of the S&P 500, Berkshire Hathaway is, and it's close to the top of the market cap table. So it's all a bit self-referential now. It's grown so big, it's almost become a significant part of the market itself, which it's buying. And they do buy back their own shares as well, which is even more recursive, if you like. So I think that's the primary problem. It's the one of scale. And obviously he makes mistakes, Warren Buffett, and obviously at a certain point he's going to die. And I'm not convinced that the people who he's going to hand over to, although he says things about them, he talks about them in glowing terms, I'm not convinced that they'll be able to maintain the returns which Warren Buffett maintained early on, because I think there probably wasn't secret sauce. There was a degree of leverage. We also did a podcast episode on Warren Buffett, and leverage apparently helped Warren Buffett. Also, the ability to have all that float and invest it and buy entire companies meant that he didn't have to worry too much about liquidity for some of those companies. And the companies that he bought early on, the cash flows generated by those generated the capital which he used to invest in other companies. So, I don't think it was luck. He's a very skillful investor. But also the circumstances and the choice of companies that he bought were pretty good. And he made mistakes later on. For example, he talked about Heinz. When he bought some Heinz, he said that was a big mistake. He has made other mistakes. And initially buying Berkshire Hathaway, if you read his comments about that, that was a mistake until he transformed the company into a kind of umbrella company which bought other companies. So, insurance is something that's worked very well for him. But he says himself that he was lucky to live in America. And it's interesting, in May, he was talking at the last shareholders meeting where I think he's going to be the boss. He said, we don't mind paying taxes at Berkshire Hathaway because taxes create the infrastructure which allowed me to invest as I did so successfully. He probably couldn't have done it unless he had the US infrastructure behind him, deep capital markets, very good business environment, a very innovative business environment, and a system of law which allowed him to operate and do things legally, and where there was transparency in the market so he could read company reports and believe them. That's always a good thing. And all of this helped him immensely. So he doesn't mind paying back into the system with taxes. He doesn't pay more than he needs to, of course, but he doesn't mind. Because he was talking about selling Apple, and he actually said the reason why he sold it a little bit, maybe too soon, was because why he brought forward the sale was because he thought that capital gains tax would go up in the US because the fiscal deficit was too large. Neither candidate was going to spend less, and tax receipts wouldn't go up necessarily. So to plug the difference, they'd need more taxes, and capital gains tax he thought was the one that they'd actually increase. So he just brought forward the purchase while capital gains tax was low, which was interesting. But, I don't think he can maintain this. And obviously he's not going to be around for much longer. He's going to hand over the reins pretty much this year, I think. So that process is already underway. So will it continue? I don't think so. And then it'll just go back to being another actively managed fund where I doubt there's going to be the ability to generate outperformance in future. And then eventually it'll just kind of fizzle away and people will lose interest. Because the magic was really Warren and Munger, and Charlie Munger. So if that goes away, I don't think there's such a kind of incentive to buy it. And personally, I wouldn't. I never did buy Berkshire Hathaway. I see quite a few people who do. And I never kind of say, oh, is that a mistake? I just think, well, why not? I don't think they'll make a big mistake, but I just don't think there'll be massive outperformance. You could just buy a NASDAQ tracker and do pretty well, I think, and get pretty similar returns now. So I hope that answers your question. And at this point, let's see, we're roughly half time. I shall summon my cockapoo. Now, in the AI notes that get generated after this call, this is the bit that says general chat and dog tricks. So let's summon the dog. Which one shall I'll rattle this one. So think of the question, like and subscribe. Subscribe to us on YouTube, on Many Happy Returns podcast. We'd appreciate that if you do. Turd. Oh, here he is. Very reluctant. No, you don't go down yet, mate. You've got to have a treat up here. He's already going for the biltong. Ted. Oh. Sorry about my second-rate snacks, mate. There you are. Yes, you're a good lad. See, he's already looking out of the door. He's waiting for Laura's whistle. She summons back. You're going to get your biltong. You can have one more treat, and then you go for biltong. One more. Come on, Ted. One more. Oh, yes. You're very good. You're very good. No more. He's got his paw on my knees, looking around. No more. That's it. You go down to Laura again now. Go and get the biltong. Go and get the biltong. With Laura. Good boy. Oh no, we didn't do your standing trick, did we? Oh, he's off. He's had enough. Ted, do you want to do your standing trick? Here he goes. Wait. He's going to stand up. Oh, no, you don't put your paws on me. Stand. Over here. Stand. Very good. Well done. And yeah, there we go. So Teddy in action. Brilliant. You're going to go back down for the biltong. Yeah? Good boy. Brilliant. Okay, so next question. After that break. Swig. Ah, that's better. Off he goes for his biltong. Someone says, Gerard McCann says, Teddy's so good at that. Yep, very good. Incognito Pat says, 30 minutes and 2 questions answered. Shall I speed up? Okay, so back to your questions. I'm going to do it fast now. You'll regret saying that. Okay. And I've actually lost the questions as well. Just fire those up. Here we go. Next question. Passive beats active for equities, and this is from ENP, another super chat. Thank you. Yeah, and I've got a video going out on Warren Buffett on the 14th of September, in case you're interested, about why he's holding so much cash. It may not be what you think. So thank you, ENP, for your super chat. And you say passive beats active for equities, but is active better for bond funds? Also, what are the uses, benefits and risks of targeted absolute return funds, such as Aegon Absolute Return? And you've given the ISIN code there. Okay, so let's have a look at Aegon Absolute Return. I'll just fire that up so we can have a look at it in a second. But to answer your question about bond funds, look at the SPIVA reports, and they have them for fixed income as well. And you'll see that the outperformance, actually it's Morningstar. Morningstar does an active versus passive report. And what they show is that for active bond funds, again, I don't think they outperform net of fees on average. I think it's a bit better than it is for equity, but I still don't think it's very good. Remember, for a corporate bond fund, it's very much like stock selection. You choose the issuers which you think will outperform because their credit spreads will tighten, perhaps. But for a kind of general kind of fixed income portfolio, or for a government bond fund, it's really much more about choosing the duration which is correct. So if yields are going up, you choose a duration which is short. You shorten duration of your portfolio, so you lose less. If you think interest rates are coming down, you lengthen duration beforehand. So this is it. You've got to anticipate which way the yield curve moves. And it's actually very difficult to predict. So many times people don't get it right. So I think the difficulty always is kind of outperforming net of fees. If the fees are high, it's very difficult to outperform. That's true of equity and of bonds. So as long as the fees aren't particularly high, I think the chance of outperformance is greater. But, you know, expensive funds usually don't outperform. But have a look at the SPIVA report, and I think you'll see that I think there is a SPIVA fixed income report. Let's see if we can find it on the fly, live. Here we go. Fixed income results. And this is for, okay, 2023 this was, but you know, you don't see a huge amount of variation year to year. So this is SPIVA, which stands for S&P Index versus Active. And let's have a look at fixed income. There we go. Fixed income results with an underperformance rate of 59%. So that means that almost 2/3 of active fixed income funds underperform their benchmark. But 9 out of the 17 reported categories posted majority underperformance. One extreme, 98% of funds in the general investment grade category and 80% of the high yield funds. Remember, that's where the single stock selection equivalent is closest. 98% of those, 80% of those underperformed. So choosing the names is tricky. Choosing the duration, there's a 50-50 chance you're going to get it right. Rates go up or down. Municipal debt, again, you can choose the issuer. That probably makes a big difference. Emerging market debt as well, you choose the issuing country, so that makes a difference. And there you did see majority outperformance, which is kind of interesting. So certain parts of the fixed income space in the US, certainly municipal bonds and EM debt in emerging markets, in the emerging market sovereign debt space, those were places where you saw outperformance. Presumably that's because there are inefficiencies in those markets. But it's interesting that you do get kind of outperformance in some of those sectors. But then fixed income underperformance increased over time. So if it was due to luck rather than skill, what you'd expect is that the outperformance would diminish over time. And that's exactly what you see, unfortunately. So, yeah. It's never very reassuring, is it? Still, let's go to the Aegon Absolute Return Fund. And I'm about to accept everything. And let's have a look at this one. Oops. So what is it? So absolute return, if you're not category global flexible bond, sterling hedged. The objective is to generate positive absolute returns for investors over a rolling 3-year period, irrespective of market conditions. So just to be positive is not a big ask, I don't think. Let's have a look at its price over time, and we can use SharePad for that. Here we are. And here it is. And you can see that it's done what it's supposed to, which is positive returns. Whoops, maybe not during the 2020 sell-off, but overall, yeah, it doesn't have many falls over a 3-year period, which it's designed not to. What does it invest in? Let's have a look at the portfolio. That usually gives a bit of insight into what it does. Yeah, so we've got some UK corporate bonds. Let's break it down by country. Countries. Yeah, so UK 40%, and France 11, Germany 10. So European corporate bonds, and mostly in the UK. And there are some corporate bonds there. Maybe, does it have gilts? The duration of the fund is fairly, it's not very granular, is it? And it's not sorted by time. So mostly in the 1 to 3 year bucket is where the maturities are, with a fair old slug between 20 and 30 years. So 1 to 3, 5 to 7 is where the bulk of the maturities lie. And then you've got kind of a long tail as well, up to 20 to 30 years. So, yeah, it manages quite a lot of money, 161 million. The fee's not particularly high, 0.3, which means it's more likely to do its job. But, you know, would I buy an active fund here if all I want is capital protection? Probably not, I'd say. You know, I'd just go for a short-term gilt bond ladder, which is currently generating about 5%. A money market fund would be generating about 5% at the moment. And that probably does reasonably well. So instead of overlaying the Nasdaq, let's overlay. I got it? No, I haven't. Have I? I'm just looking for a money market fund. CSH2 will do here. And all instruments. Here we go. Okay. Here we go. So the blue line here is the money market fund, which has a fee of 0.07%. And you can see that, okay, this has been outperforming a little bit recently, but it kind of deviates above and below that very low risk money market fund. So roughly what you're generating here, with the exception of this hump here, is the risk-free rate. So, you know, I'd rather pay 0.07, I think, for the CSH2 fund, rather than pay, 0.3? I think it's 0.3 for this fund. Yeah, 0.3 for, you know, the sake of potential outperformance, which probably doesn't happen. So, yeah, it's not looking great for fixed income either. Next question is from Janick Modi, also a super chat. Thank you, Janick. He says, I have 160k lump sum that I need to deploy. Current market levels are making me nervous about starting my drip feed. The plan is to invest 10k per month and increase to 20k if market turns bearish. Look, I think that's a good plan. That means that you're going to be investing, you know, let's say that markets don't turn south. That means that you're going to be investing for 16 months. So that's a fair old period of time. Usually people drip feed over the course of a month, over the course of a year. I did it over 2 years, so that was 24 months, and you're kind of in between those two. Usually drip feeding sooner rather than later is better to reach your final allocation. You don't have to drip 100% into equity. You could drip into a mixture of bonds and equity. So if you're not comfortable having 100% equity at the end of it, you could always drip feed into that portfolio as you go along. So you don't have to take a huge risk at the end of the period. So just make sure that the allocation you're heading towards at the end of the drip feed period is where you want to eventually be long term, which may not be 100% equity. But, you know, would I drip feed in this kind of market? Yeah, because I'm worried about US valuations. So let me quickly pull up US valuations. Let's use Yardeni. I like their website. Yardeni, and here we go. Share. There we go. I'm going to move down here, make myself a bit smaller. Right, so let's have a look at the S&P 500 forward PE ratio. No. Oh, here we go. Forward earnings per share. Yeah. That's forward earnings. And forward PE. Forward revenue. We'll get there. Forward PE ratios. Here we go. So small caps in the US, not particularly expensive, at a huge discount to the large cap S&P 500. So the S&P, don't want to do that. The S&P 500 is at 21.1 times forward earnings. That's the red line, which is very expensive compared to history. Last time it was this expensive was, well, we're getting close to where we were in 2020 during that euphoria. This market sell-off will have taken some of the edge off that, but not a lot. And then if you have to go back all the way to the dot-com bubble euphoria to have a comparable multiple. So I think, you know, that's what we talked about. One of the things we talked about in our mean reversion podcast episode, which you can hear on YouTube. Just go to youtube.com and let me just get the URL. Yeah, so it's youtube.com/@manyhappyreturnspodcast. Please do subscribe. But you can see that discrepancy now is huge. It's probably the widest it's ever been. It's kind of comparable to where we were just before the dot-com bubble burst. So, you know, big discrepancy between large caps and small caps. And, you know, I'd probably be pretty cautious in that kind of environment because the probability of a sell-off is slightly higher when valuations are high. So, personally, yeah, I think drip feeding makes sense. And all I'd say is that if you're just normally saving as you earn and investing as you earn, don't hold back, because if you hold back there, it doesn't usually work. But if you have a big risk aversion, which I do, I'm very nervous about investing in stocks, then certainly the drip feed could be your way of climbing the wall of worry and investing in the long term. It worked for me. Has Ramin covered, next question, Gavin Lawrence, has Ramin covered JEGP? If not, thoughts versus QYLP? I think I have looked at it in the past. I think it has come up on the TF. Have you got the right fund? JEPG, maybe? Is it the one which has covered? It is a covered call fund, isn't it? But it's actively managed. Let's see if I can find the right one. Do you mean JEGP? Yeah, I think you might mean that one. JEGP. Yeah, that's the one you said. So let me just pull up the fund fact sheet. Yeah, so the idea here is you want capital growth, of course you do, but you also want a good income. And I think this is a covered call fund. Yeah, here we go. So the fund will sell call options, and the reason why it does that is that it wants to generate additional income. So this thing, the yield will be high. Let's have a look at what the yield is. The dividend yield. Can we find it? No, we can't. Performance, dividend history. So the annualized dividend yield, notice, is particularly high. If you have an average global equity fund, it's going to be around, what, 1-2%, because it's US dominated. This thing gives you a pretty chunky dividend yield. And some years it rose to like 6% or more, 9% in around, what year was that? That was 2024. So this thing is paying out monthly. And it's paying out a fairly chunky dividend some months. So how does it generate that? Well, it sells upside on some of the stocks in its portfolio, which it actively chooses. So presumably it sells the upside on the stocks which are volatile, but where it doesn't expect a lot of upside. And then it keeps long exposure to the stocks which it thinks do have a lot of upside. And it's done that fairly well, presumably. Now the one I own is not that one, it's QYLP, which you mentioned. Let's have a look for that one as well. Yeah, so this one's been around since 2023, so not very long, but yeah, so you get a fairly high income, you get capital growth, so you don't worry about losing your real earning power by that thing losing value over time in real terms, because a lot of funds, for example, if you just buy lots of UK high dividend yield stocks, the capital growth on those is very poor, usually doesn't keep up with inflation, so in real terms the income will fall over time. So I made a video called Dodging Dividend Disaster where I talked about that. But this thing, it's got capital growth and it's got the high dividend yield, which is probably a good combo. The fee's not particularly high, 0.35, which you can't see, 0.35 here, and that's pretty good, and reasonable AUM, so it's going to be around for a while probably. The other one I've got is QYLP, which is not really actively managed at all. It simply goes to the NASDAQ 100 and sells upside calls on it, struck at the money every month. And so the dividend yield on that fund, because the NASDAQ is so volatile, is 12%. And I've set it up as a pie on Trading 212 such that the dividends are reinvested. So every month I own 1% more of that. I keep all of the downside of the NASDAQ. So if there's a huge fall in the NASDAQ, then I'm going to pay the price in terms of capital loss if I sell, which I won't. But what's good is that the volatility then increases and you buy more stocks per month because you're buying them at a lower price. So I kind of like that risk reward of QYLP, and I've increased the amount I've got in it recently because I'm in a race with Laura to see who can generate the best returns with it. So yeah, that's the one I've got, QYLP. And the dividend yield on that is a staggering 11.4 at the moment. So that's why it's so high, because of the selling of the call options. The sacrifice you make is you sacrifice some of the upside. That's what you do when you sell the call options. You sell the upside to someone else who believes in it because you don't. Yeah, so I hope that helped. And I'm getting through them faster now, notice. Gavin Lawrence says, yes, I'm in London. Okay. Amir Ketobchi, hello, Amir, salam, who says, super chat, thank you. The PM ominously says the budget is going to be painful. Looks like the UK average investors are going to get whacked. Any action we should take? Keep up the good work. Well, I mean, just speaking to people, and usually the people I speak to are quite high net worth, they have already brought forward sales of assets which are not in an ISA or a SIP in order to pay a smaller capital gains tax than they expect will happen in the near future with the October budget. Why is capital gain tax likely to be the one that they go for? Well, firstly, it goes for the rich. So it's a redistributive tax in that sense. So it's a kind of progressive tax, I guess you could say, from that point of view. But I think, will it be punitive? I doubt it. I think it'll probably be quite small. Plus, there are other things which we have which are very generous, perhaps too generous in the UK, such as if you want to bypass inheritance tax, put your money in your SIP and just nominate your kids in your SIP. You don't have to pay inheritance tax. So I think that's a really overly generous ability in the UK. I think that's another thing which they may tighten up on. But, who knows what they're going to go for. I think trying to preempt these things is a mug's game because you can't predict what they're going to do. But I think the idea that they're going to, raid the coffers of the rich, I think that's just not consistent with this Labour Party, this instantiation of it. Because if they do want growth, then they also want aspiration. And I think it's going to be a problem for growth if you just whack people over the head as soon as they succeed with higher taxes. So I think it won't be punitive. If it is capital gains that they go for, it'll be incremental. And I think it'll probably have a fairly high threshold, and it'll probably not be a huge increase, would be my guess. But, overall, I think their policies are pretty good because they are trying to get growth, but I think their big mistake has been to have these fiscal handcuffs and say, look, we're not going to increase debt to GDP, when markets probably would be quite forgiving of a 5-10% increase in debt to GDP, as long as it wasn't crazy like the Kwarteng and Trust budget was, which came at a time of high inflation, which had unfunded increases and very large unfunded increases combined with tax cuts, which was just crazy at the time. And obviously it crashed the bond market, almost caused insolvency of some pension funds, crashed sterling, increased the cost of borrowing for everyone, and we paid the price for that for a long time. But I don't think we're in that kind of bond vigilante space if we just increase debt to GDP by 5-10%. And it was well telegraphed, it was well costed by the OBR. We didn't sack the head of the civil service just before we did it. We didn't refuse to involve the OBR in making the forecasts for the impact. All of that stuff was just terrible. And I don't think that would happen this time around. So I think they'd be better off doing that. But clearly they're not going to. Also, they're not going to renegotiate the trade deal with Europe, which would also be a quick win and probably wouldn't cost anything. But they've ruled that out, joining the single market again. So, that's another thing that would clearly boost UK growth. So I think they've restricted their own choices far too much in order to seem like a responsible government, when in fact it's starting to have negative consequences. So, I'd say just don't panic, Amir. I think probably they won't do anything crazy, and you can never predict it anyway. Next question. Oh, and also interestingly, if people bring forward their sales before the budget, well, essentially they've already done the job of the government for them, which is to increase the revenue for capital gains tax, because they crystallise the gains now, and that already bulges the kind of coffers of the Treasury. So even just by hinting that they might raise capital gains tax, they can actually boost the tax take. So it's kind of clever, if accidentally so. The last question, oh no, it's not, gosh. Mal says, think you're becoming a member. Will the PensionCraft members share knowledge with a novice? Or is it not really for beginners? Or is it not really for beginners like me? We have many beginners, so I really wouldn't panic about that, Mal. Also, we've kept the cost low, so it's £16 a month, so you don't have to stay with us. Just stay with us for a month, see if you like it, and if you don't like it, you can always cancel your subscription. We don't lock people in. Some people go for the annual subscription, but if you do want to learn more and just try it out, just go to pensioncraft.com/membership, and you'll see it's very easy to sign up and it's very easy to cancel. We won't try and keep you there captive. The PensionCraft community. Weirdly, people stick with us for a long period of time. We have very low churn. I think it's because people like it. Maybe. I assume that's why. But it is a kind of friendly community, and people help each other. That's what amazes me. And the quality of the questions that people answer to each other now happens faster and better than I answer the questions, and I'm very proud of that. I'm very proud of a community where you do have these helpful people, which help people of all abilities. Lots of people are new to investing, so don't think that you have to be like a fund manager or an expert to join. You don't. You really don't. Yeah. So next question is from Palab Ghosh. Love your articles for the BBC and your kind of clips. He also went to Imperial, like I did. And Palab says, what do you think about buying the Dividend Aristocracy? So Dividend Aristocrats. Yeah, I think they're kind of interesting as high-income funds. There are some questions about the management of them and also the costs of Dividend Aristocrats. They're not the cheapest funds. If you are going to go for a high dividend yield fund, there are probably cheaper options out there. But look, they've been around for a long time. Let's have a look at one. Aristocrats. So these are managed. Let's get some of the examples. I mean, it is a generic term as well, apparently, but there are some dividend aristocrat funds. But look, whenever you're going for a kind of income approach, always be sure that you're not getting reduced capital gain, because the risk is, let's say you put in 100,000 into a dividend generating fund. If it's something like IUKD, let's have a look at that one. I'll show you the problem. So this is the iShares UK Dividend Plus Fund. And let's have a look at that. So this is the price of that over time. Now notice the black line is the actual price of the fund. Now it's been throwing out dividends all the time. It's an income fund and it's generating a good yield. It has done for a long time. But if you'd put in, say, 100,000 in 2005, well, now the value of the fund would be down in nominal terms, down to 7.5, because there's been no capital gain. Also, inflation would have eroded the value of your capital further. So you'd have had a real income which would have fallen over time, very dramatically. I think it was something like 70% over this period. And that's a problem, which is why that fund that we discussed earlier is interesting, because it generates a high income by selling call options. Not QYLP, the actively managed one from JP Morgan, and at the same time it kind of has capital growth because it buys stocks which go up in value. Or you could create a synthetic version of that by having just a global equity index fund mixed with a high income fund, one of the covered call funds, so that you get a bit of both. You get capital growth and you get the high income. So you can be quite creative with this. Just don't overpay for dividend aristocrats, because sometimes the active management fee is quite high. But yeah, I think they're one way of generating an income in retirement without having to sell anything. But focus on capital gain and as well as income, because you can always sell some of the fund in order to generate your post-retirement income. And if you have a high total return, then that can keep you going, right? Doesn't make any difference whether you have to sell something. And specifically if it's in a SIP, obviously you don't incur capital gains tax if you have to sell something. So you don't care whether you sell or just receive dividends on things you already own. Next question is from Ganok, who says, what do you think of NTSX on Just ETF? Okay, so he also tells me where to look it up. Handy. What was it? NTSX. And I'm going to overrun, aren't I? NTSX Just ETF. Here we go. Funds on the fly, we should call this. Okay. So this is the Wisdom Tree US Efficient Core UCITS USD Unhedged Accumulation Fund. So it buys US stocks. What's the party trick? 90% exposure to large cap, 60% exposure to US Treasury bond futures. Ooh. With the intention of delivering a leverage position to a traditional 60-40 portfolio. So this is a little bit like a risk parity fund. So let's have a look at the returns on this. That could be interesting. Oh, hasn't got it. That's not good. I wonder why it doesn't have it in. Let's have a look at the performance. So year to date, up 12%. Yeah, I mean, it's interesting. We'll just have to see how this one performs. Historically, if it is like a risk parity fund, then remember what the futures do is effectively create a levered position in the treasuries, in the government bonds. So the idea is that you have something with a lower risk premium like treasuries, and you boost the return on that with leverage, such that the overall return contributions are the same from the equity component and the bond component. Now, if equity markets and bond markets fall at the same time, if there's an inflation spike, for example, as we've just had, that can be a huge problem for these funds, because you get the leverage loss on the treasuries at the same time as you get the fall in the equities. So as long as that doesn't happen, as long as the correlation between bonds and equities stays negative, which is usually the case if inflation is low, which it still is, which it is again now, then everything's fine. If inflation spikes, what you end up with is a levered loss on the bonds and an unlevered loss on the equity, which can be problematic. So if you think inflation's going up, don't buy it. If you think inflation's now under control, reasonable investment. And it's interesting that the fee's not too high on this, 0.2, which I think is great. I hadn't actually come across that before. Thank you for sharing that. And I think we're almost there. Yes. ConCon MCMC. Okay. Hi Ramin, smiley face. Have you considered running an ad hoc meetup at all? We did do one in a pub in London recently where a couple of the hardcore PensionCrafters came, and we had a nice afternoon. I really enjoyed it. Do you listen to the Rest is History podcast? I do, and I love it. And any thoughts on upcoming budget? In fact, I've just read, so if you follow me on Twitter, you'll know this. I've just read, this is my Twitter handle, Ramin Charles, rather than the PensionCraft one. I've just read Politics on the Edge by Rory Stewart, and I absolutely loved it. Brilliant book. You just see how awful British politics can be when you're actually an MP, how little you can do, how little power you have as an MP. So he was up in Cumbria, Rory Stewart, that's where his constituency was, and he was trying to get broadband for his constituency, and it was just really difficult. And he talks about the difficulties he had doing that. Then he becomes a government minister, gets moved around different departments, and then the Conservative Party imploded, and we all know what happened next. And he left politics after that, and he now does a podcast. But I loved the book. I love the podcast. It's very good. The upcoming budget, I think, I'm expecting that it won't be so bad for investors as people think. I think they're setting people up to think it will be awful, but I don't think it'll be that bad. Simply because pensioners vote a lot, and that means they have a lot of power. So I think it's unlikely that pensions are going to be really in the crosshairs for a massive overhaul. You fiddle with pensions at your own peril. You probably won't be re-elected if you do. So I think that could be massively unpopular, as well as having taken away the energy payment to pensioners over the winter payment for pensioners. I think taking that away means that they've already kind of shot their bolt when it comes to hurting pensioners, and it's unlikely they'll do more in that space. I think they'll probably go for capital gains and some kind of inheritance tax for pensions, maybe some kind of reduction of the pension benefits, of the tax benefits, the tax deductibility of pension contributions. That's the kind of space in which they'll operate. But will it be massive in terms of its impact? Probably not, I'd say. But I think trying to predict these things is pointless. Look, we're going to cover it anyway, so you can watch it on this channel, and Michael and I will probably talk about it on the podcast. Anyway, look, I've overrun, and thank you all for joining us. And don't forget, please like, subscribe, have a look at our podcast, Many Happy Returns. And just to go over the URL again, the URL for that is youtube.com/@ManyHappyReturnsPodcast. So it's youtube.com/@ManyHappyReturnsPodcast. And please do subscribe there, because obviously it helps us, and do listen there, because we've just kind of launched it on that platform. And do listen to it, because we just did one on mean reversion in markets. What goes up must come down, which is particularly relevant given the wobble we've just had in terms of where we might be headed. So thank you for joining us. Thank you for your brilliant questions, as always. They're always great. And thank you for the super chats. Thank you for your support. And we'll speak again soon. Take care, everyone. Bye-bye.